Hello and welcome, everyone. I have an awesome workshop on mergers and acquisitions. You're going to hear the very latest of what's going on in the industry. I'm Dr. John Randall, the founder of XFA, and we got an exciting one for you. We got a lot of great stats. We're going to talk about what the latest is, and we're also going to talk about how practices are winning with acquisitions, but also the constraints that are holding them back from getting there. My co-host is my man, Aaron Hassler with Spruce Rock. He's going to take us through some of this. So Aaron, thanks so much for putting this together and being our main speaker today.
Likewise. Thanks, John. Appreciate it. I always like talking to you. So this will be a good time today.
Yeah. So what's the latest here in M&A? You have great stats, great stuff I've learned from you.
Yeah.
So
Yeah.
what's the latest? What's going on?
It's been an interesting market. And I think, as you and I talked about, John, we're going to really kind of focus today's message on buyers, right? I think the majority of advisors at least feel like they're buyers. And, if you're a seller in this conversation, you're thinking about selling. Yeah. At the end of the day, we're going to give you some kind of inside baseball on how buyers are approaching this market and what they're doing and how you can apply it to your position. And feel free as we go through this. I think we're going to have some time for Q&A at the end so we can tackle, some of those sell side questions as well. But, as you guys know, John, the market's up, and that means M&A is hot. Interest rates have started to come down, and we're seeing that this is still an incredibly competitive landscape for acquisitions. Probably the most competitive landscape right now is in that $500 million to $1 billion in assets under management. But we're going to see, and this is where probably our target audience is looking at, is that, those who want to acquire something in that kind of 100 million to 500 million in assets under management. We're still looking at this demographics play. We have a lot of advisors pushing towards retirement. We're seeing more and more advisors retire early compared to the previous generation. And so there's a lot of activity to be done there, but it is probably as competitive an environment as it ever has been in M&A today.
It's a great point. I really see the same. We coach a lot of the fastest growing practices in the industry, a lot of Barron's top 100 in acquisitions, big part of their game. And it's tough out there, and prices are driving up. It really is. And which is good. It's a great sign that there's a lot of health in our industry, that there's hunger for it. But I think getting to some of the insights we have and how advisors are winning here, it's going to be fun to uncover that here as we go.
100%. I agree. One of the things I was interesting is just we were doing a little bit of preparation for this, John, was that, growth is obviously everybody's kind of number one objective in this business, right? And we always know that organic growth is a good foundation for your business. But we are seeing is that when you can acquire a business and bring on another 100 plus households or more, growth is exponential. So there was an article just within the recent months that, found it, if you had purchased an acquisition, or if you'd purchased a practice between 2020 and 2025, the average growth rate for a firm was north of 95%.
Yeah.
Whereas you compare that to if somebody had just been going about their business and growing by referral without a focused intent, it was really only 8.5% over that time period, which is a pretty stunning difference, right? And I know there's some firms that are going to hit in that middle segment. But at the end of the day, acquisitions do help you really catapult your firm and, I think integrate in a lot of the things that you speak to your clients about, John, which is, building out a bigger enterprise and kind of taking those steps up to an organization with real enterprise value.
Yeah. Today I was talking to the number 5 ranked Barron's independent advisor. So we worked with for a lot of years, and we're talking about just what it takes for growth rates. I mean, they're doing about 100 and close to 150 million in revenue on AUM. That's their revenue. They got over 17 billion in AUM. And so it's hard to keep up with growth rate at that level, right? If they buy 100 million of AUM, it doesn't even move the dial. It's not even noticeable. So it really is a way to exponentially grow, to have an acquisition. So if you're listening, if you're organically bringing in maybe 10 million a year in new assets, it might take you 10 years to get that extra 100 million, right? Whereas you can go and acquire 100 million and be there right now. So it really is an exponential growth. It's so interesting to see, though, the industry stats of how much faster people grow when it is hey, there's a lot of acquisitions here versus just purely organic. I'm a fan of organic.
Me too. Me
Um,
too.
it's a very profitable thing that happens, but there's only so much growth potential as is what you found. It clearly
Yeah,
indicates that it's only 8.5% growth.
it is. But I do think that organic growth and really understanding your own business is essential to a good M&A strategy, right? And I think it breeds M&A opportunity for the right firm. So I think we'll talk about that as we go. And so what I want to tackle today is a little bit of kind of what's happening in the landscape today. Who are the competitors? What are your target markets, and how do you put yourself in a position to be successful with M&A? Because I think one of the things we talked about, it obviously it's a great growth engine. The right M&A deal is fantastic for your business. I think the wrong M&A deal is going to put gray hair on your head and really constrain your firm or tie you down from the things
Yeah.
that give you energy, right? So I
Yeah.
think it really is critical to do this, but do it well. And for those that are in exploring, kind of getting into this, or are doing their first merger and acquisition, I think there are a lot of key takeaways that we're going to provide here today.
Yeah, you know what
Um,
happens a lot, Aaron? It's the excitement of getting an acquisition sometimes outweighs some of the red flags in a deal.
Correct.
And
Without
and I
question.
can tell you some veteran buyers, they look back and they say, "Oh my gosh, I look at my first few deals, like I wouldn't have done out of the three of them. I was just really excited about getting them." So it's important you've got a process you follow to evaluate what you're buying to make sure you're getting a good deal and you're not just really excited about it because there's good deals and there's not good deals out there. What you're buying, the clients may be a fit for your practice. They might not.
Yeah.
So you really got to have a process here. That's what the veteran buyers that are doing a lot that achieve double-digit number of acquisitions, they get better for doing it a lot. But as they look back, they say, "Gosh, I wish I had a process." And that's what we try and shortcut for a lot of people. Is just give them, "Hey, here's the playbook. Let's make sure we got some parameters here to evaluate if it's a good deal for you."
And that's one of the big takeaways for the M&A market the last couple of years, is that buyers are becoming more selective. And so it's something to think about, not only as a buyer, but as somebody that will eventually sell your firm, which is really all of us, is really understanding what goes into buyer selection and how our firms evaluating today. Because I think it really puts you in a position, for your clients on, all right, where are we going to spend our time and our energy and our key initiatives as we grow as an enterprise? Um, so John, let's talk a little bit about this. As far as, who's the competition? I think what's interesting is in the 2026 market here, we're seeing still a ton of big enterprises with private equity backing that are chasing smaller and smaller targets. We still see new entrants into this marketplace, meaning private equity or private debt firms that are coming in and looking for that first acquisition or two and willing to pay up. And so as a buyer, you really need to understand who you're competing against and be ready to position yourself, not only from, I think, a presentation standpoint in talking to the seller, but be prepared to talk price and be prepared to know what your market value is so you can know how high to bid, right? So what we're seeing is there's these aggregators, integrators, they're I say they're kind of one and the same. If you're an integrator, you're going to say it. I'm not an integrator, or I'm not an aggregator. I'm an integrator. But point being is, an aggregator and integrator are these national brands that people are seeing, and they typically have hub offices in major cities. And then what they're doing is chasing M&A targets, it really as small as 50 million for that matter, that they can tuck into some of their existing offices. And so if you're an independent buyer on this call, what your advantage is here is to look at, who is my seller talking to? Is this an individual conversation? Do they have representation? And understand, what that buyer is. So we see these aggregators and integrators are big buyers. They're private equity backed. They're coming in with a formulaic deal structure. What's also entered and increasing presence is the broker dealers themselves, right? We're seeing more and more broker dealers that are saying, "Hey, I'll come in, buy your firm." It's kind of almost a rent to own type of program. They'll buy into it. And then sometimes the employees can buy it back after 10 years, or they're just ready to come in with a strong offer and integrate you in. And then we're seeing just the regional players. It's, what I would consider the original OSJ office, right? In the broker dealer model, for those of you who haven't been in it, there was the Office of Supervisory Jurisdiction, that OSJ, and those people typically have a back office. They add some value, whether it's their RIA or their broker dealer entity. But they have a number of advisors. And so those individuals are typically hiring consultants or business development people to go out and find deals and then cast them into their network of advisors, right? And I always joke is beware of the drive-by LOI. What's really developed over the last couple of years is the idea, and this is my best joke, is people will literally tie an LOI to a brick and then just chuck it through the window as they're driving by your office. And it's the idea that they're not taking the time to get to know you. They're really just throwing that, LOI at you as quickly as possible with typically a 180-day retention clause to it, or exclusivity clause. And so as a buyer, you need to be cognizant of that and be ready and prepared so that if you have an indication a seller is coming to market, you can respond quickly and be ready for the information so that somebody doesn't just sign that first LOI that they come across and start to get into talks with someone, and then they're kind of tied up and handcuffed until, that deal gets spit out, right? So I think that's an interesting development and concept, and but there are ways, and we'll talk about that as far as how you can combat that.
Yeah, I think before we get into what we're seeing in deals, and it's so much fun doing this with you, Aaron, and Spruce Rock. I mean, I think you all are one of the best lenders in our industry, and you see so many deals, right? So you really have a good read of what's going on. And I think working with a proper lender, there's some training wheels on the deal where it's okay, what's going to be a good deal for somebody and can help guide them through the process, which is great. But it is interesting you talk about the regional firms that have a hub office in a city and they're just buying locally. It is pretty profitable. You can buy something without overhead, without staff, without needing an office, right? I think as you look at acquisitions, if you're buying a whole bunch of overhead with staff and an office, something like that, it changes the economics a lot.
Yeah.
Whereas if you're newer to the acquisition game, you're buying some people smaller than you that are local to you that don't have a bunch of staff. It's really quite proud. The numbers work so much better in that way. So you offered some insights there, and everyone should be paying attention to that. Even if you're have multiple billions under AUM and you're buying firms, it is really profitable that, you buy enough that moves the dial, but it doesn't break the bank. From a cash flow standpoint.
And one of the things that I think, is culture is really what is, I think, winning a lot of deals these days. And as an individual buyer, you have a lot of opportunity to kind of demonstrate who you are as an organization, what your culture is like, and really sit down with that seller and kind of understand, why are they coming to market? What's their interest? What are their needs as a business owner? And what are they looking for in a succession plan? And your biggest advantage as an individual buyer that's going to, use whether it's cash or debt financing is you can customize deal structures to an infinite number of possibilities. And we'll talk through that. But the average kind of private equity backed aggregator integrator is going in and saying, all right, we're going to provide 70% in cash. We're going to provide 30% in an equity rollover. And then there are incentives beyond that. But when we look at those incentives, if you look at some of these LOIs, they're often fairly challenging for a firm to hit without some significant change in the seller's lifestyle and or, experience with the team. And what I mean there is, one, you've got to roll over 30% to stock and hold on to that for a period of time. You've got to understand what that stock value is, right? But then typically to really hit the earnout metrics and those kind of extra EBITDA multiples that are being offered out there, firms, the buyers typically want to see 20% growth. As we just talked about, most firms today are not hitting that without significant outside effort, and that typically is M&A. So as a buyer, you actually have more, I think, purchasing power than you realize. It just requires understanding the different deal structures, understanding what your value proposition is, and really being able to appeal to some of the nuances of that particular seller and customize your deal, to build that relationship and build that trust.
Yeah, that's a great point. That the buying power through, through debt and lending through you all really is significant. It really is. But the reason that in X of A we're so big on driving profit, because the more profitable your existing firm is, the easier it is for you to go get other deals.
Yeah, there's
Um,
no question.
yeah, I'm actually working with one Barron's Top 100 practice and buying another Barron's Top 100 practice, right? And their existing practice is incredibly profitable. The deal they're going to get isn't that profitable at first. They'll make it profitable, but because they're so profitable, they can do it, right? They can do the deal and make it happen. So it's important that at the end of the day, that's the big metric. I know we're all about we need more AUM, we need more clients, right? I need to grow my GDC or my revenue. That stuff's important, but you also got to really grow the profit margin as a business, because that in itself creates a whole nother level
Yeah.
of buying power.
Yeah. Scalability, right? I mean, we'll talk about that, right? I think it's the ability to kind of adapt and create scale in that acquisition and service the clients the way they wanted to be. But it usually means you've got the personnel and the scalability to absorb that acquisition.
Yeah.
One of the things along that line that I always talk to buyers about is, know why you're buying and go out there and set objectives. And that's why I like talking to you, John, is you're out there talking to your clients every day and helping them set business goals and metrics. And I think as a buyer, you're not going out there to just say, hey, I'm a buyer. You're really going out there to say, hey, I'm a strategic buyer. I'm interested in the right practice. And one of the common questions we get at Spruce Rock is, how do you find sellers? And I think the best way to find a seller is to know exactly what you're looking for as a buyer and be able to share that with your network, with your centers of influence. And so you have to look at yourself and whether it's through John's consulting process or whatever, and say, what are my objectives for buying this practice? What are my goals, both in the short term and the long term for this acquisition? And what are the enhancements that it can make to my enterprise? Or am I searching for a firm that can help me with those enhancements that I want to make, right? It's that introspective. And the more you know your own practice and your own objectives, I think the easier it is to say to, the wholesalers out in the industry, or your broker dealer network of people, or your peripheral consultants, your business coach, your marketing consultant, whatever, and say, hey, I want to buy a practice. This is the size I'm looking for. This is the type I'm looking for. These are the features that I want to see. Most of these practices are out there, but sometimes being that specific also allows people that are in your circle to say, oh, that makes me think of so-and-so. I should make that introduction. I should talk about that. Because there are so many buyers coming at your average seller that you really have to figure out how you can network in the door and create that individual connection. And I think, identifying your target market and knowing your specific, features that you're looking for really demonstrate that and allow you to identify those sellers.
So it's a really, it's really great insights here, because something I caution someone that has not done double-digit number of deals. Look at back when you were a new advisor, right? And we've been there. We've both been advisors, and it takes a while for you to get really good, right? It's a tremendous amount of effort to get that first client. Your new clients. After you get 100 clients, you're pretty good, right? You got it down. It's pretty good. But it's the same, these initial deals I think are dangerous, even if you don't have double-digit number of deals yet. The ones that have really bought a lot, they constantly get better as they go. And again, we try and shortcut by having processes that actually work, that shortcut people's learnings and applying it. But being selective, as you said, you mentioned the savvy buyers are being more selective. I think there's even though there's a lot of competition, there are deals, and I find that like the private deals, like Advisor, that's out there, right? Those are some of the best ones. Maybe someone's been in your town, you've known each other for a decade or decades, right? Those are the easiest deals, as opposed to bidding on something where you don't know anyone. It's very cold. It's difficult. It's difficult. And end up actually, those cost more too, which aren't ideal.
They do cost more. I would agree. And I, but that's where it goes back to, I've talked about this is, knowing your profitability per client, knowing what your average revenue per client is, make a big difference. Because one, you can, be able to identify what your target is, but also you can then start to evaluate those aspects of the selling firm. And it's a lot of due diligence, right? The better you understand your own firm and your own metrics, I think the better it is to understand and evaluate what you're looking at.
Yeah, yeah, it really is. And it's surprising how many financial advisors aren't really clear on their data, right? We've talked about that often, whether it's their practice data, whether they're, broker dealer RAA or Mosaic reports for them, or if it's just knowing their financials too.
Yeah.
I'm a big fan of one of the studies I like the most. I'm interested in a lot of research, read a lot about our industry, will buy research. The investment news study that comes out every year is one of my favorites because it
Okay.
goes deep on all kinds of stuff, right? What are practices paying people? What's the average P&L in there? And it's helpful to know where you stand against the industry. Because I've seen a lot of practices come to us that are big that actually are not profitable because they
Yeah.
just bought,
Yeah.
they hired too many people, they paid them too much, they made a lot of common mistakes. Now like, oh my gosh, I'm running at like a 12% profit margin where industry average is like 47, according to investment news study. And that's, owner's comp plus true profit margin is at 47%. So, if you're not running at a higher margin, it's a constraint, right? It really makes it difficult to grow and scale, to hire the people, to service what you're bringing in, whether it's organic, inorganic, or both, right?
Yep.
I mean, that's really the keys to scaling is how can you accelerate those? But it becomes a capacity management game. And the only way to really get good at that is by having enough profits. You can be able to hire the next two to be ready for what you're bringing in the front door.
Agreed. The other one I like is just the Schwab advisor study that comes out annually.
Oh,
They have
great one.
a ton
Yeah.
of participants in that. If you participate in that study, whether it's Schwab or Fidelity or really any of the custodians, I think do a great job of it, is
Yeah.
participate in those. You get your feedback, your target size, and you can measure and compare your stats. But that's why I'm always just a big believer of having a business coach and the idea that you can say, okay, let's look at our own numbers. Let's compare what we're doing to the industry benchmarks. And if we're behind on that, let's step it up and let's measure into that. Because that is a big, one of the things we talked about with M&A is in a highly competitive market, you have to build trust with that seller, and you really have to show and demonstrate to that seller that one, you can afford their business, and two, that you can handle the capacity and service the clients the way you want to. And I think that's one of the things that a lot of buyers just overlook. They kind of just think, hey, if I can make a relationship with that seller, that might be good enough. Or if I can come in with the right price, that might be good enough. But at the end of the day, I think it's really about demonstrating the kind of, feasibility of your business, whether it's that profitability, whether it's the existing service model you have, and the adaptations that you can make into that, that make a big difference. So, one of the things that we'll do as a takeaway for everybody that has attended this is, we have a buyer preparation checklist. And, I think that building trust and having that information at the ready is one of the biggest and most overlooked keys to buying success and to acquisition success. And what I mean by this is, I can't tell you how many times somebody comes to us for debt financing and they say, one, how much of this business can I afford? Or, yes, I'll get you the information so you can understand my business. And it takes them 2 weeks to collect, their P&Ls, their, assets under management reports year over year. And so I recommend everybody on this call is take a look at our checklist and start to build a folder out for yourself if you haven't already. And I should have that information after I've talked to a prospect within 5 minutes. It should be a folder that's ready within your system that you send or your CFO sends, and it's going to have your last 3-4 years P&Ls in there. It's going to have, all of your client household lists, or not, lists specifically, but how many households you have, what's your average AUM per household, what's your average revenue per household. And I really like when buyers can actually build out kind of a firm profile on themselves, because I think one of the best ways to get information and to build trust with a seller is by giving information in the first place. So, yes, seller, I'll make a connection. I want to talk to you about your business, but hey, by the way, here are all the things about my business, and this is what I'm looking at. And, most of these things are good. I have a few warts. Here are some of the warts that I have. Here are the complexities that I'm trying to solve for. And I think sometimes even showing a little bit of that, one, it just demonstrates you have a tremendous amount of insight into your own practice.
Yeah.
It shows that you're prepared, you understand what you're doing, you understand how to look at the data. And it shows that you're making decisions to continue to build your enterprise. So I really like the idea of build out, 3 to 5 slide deck
Yep.
through PowerPoint presentation on your firm, right?
Yeah.
And I think it's something you revisit on an annual basis, right?
Absolutely.
You're working with
Update
your
it.
business
Yep.
coach. Hey, let's update these numbers. Let's put together our strengths and our weaknesses, and build that out and be ready to share it. And I think what you'll find is you get much more trust and much more peace of mind, because that's what a seller is really trying to screen out at the beginning. They're trying to screen out, all right, I've got a lot of people coming at me. Who can I trust here? Who's going to give me the actual information I'm looking for?
Yeah. And something to think about for a potential buyer is that, you've got to make something intangible tangible. So you might verbally talk about things about your firm, but it's not tangible until they can visually see it, right? They could print it out. They could show it to maybe a significant other or someone in their family. Like that makes it tangible. And we have examples and models to do that, but it makes such a big difference. It sets apart the amateurs to the pros. And so if you're listening live or in a replay, if you have a deal, you're working through it and trying to get awesome, the checklist, these things will help. But if you don't have a deal, this is the time to do it, right? This is the time to get your house in order so that when you do get one, you look that much better to the potential buyer, because I'm telling you, the pros can easily outweigh a local person they've been friends with, because they don't have any of this stuff together. They don't have their data. They don't have any kind of presentation they can show. The good buyers, they got all this and they've done it many, many times. And unfortunately, they can beat you out. So we got to set you up so you don't get beat out. Right.
Well, and I tell you, I mean, I can't tell you how many examples I've seen of that, John, where someone might say, hey, I met this person through, my FBA chapter meeting. All right, we're talking, we're having conversations. But meantime, and they're kind of trying to get their house in order and they're having great meetings with that seller. But in the meantime, that seller is really doing the same thing. They're starting to do a little bit more homework. They're starting to ask more questions. That inevitably means they end up talking to other people and outside influences. And some of these professional buyers, some of these aggregators are really good, right? They're coming up with big data. They're coming up with big structures. They're coming up with big EBITDA multiples that look awesome on paper. And so that's where you really have to be ready and quick in building that trust early. Either so they don't consider or entertain other outside buyers, or just so you can keep, bringing it back to center and demonstrating your skill set, and your kind of value proposition as an organization.
Yeah, I think to continue this, Aaron, I'm really excited to hear from you the latest in deal structure, multiples, things like that. You have so much data on that. But to me, you're really talking about the constraints that are holding advisors back from growing faster, from scaling faster, from getting more deals. And so, I mean, we've been doing consulting for 22 years. These are some of the things that we see that are holding practices back from scaling. And the first one is capacity. So a lot of times, you as an owner, you might have too much on your plate, too many clients, too many duties. And that is the bottleneck of the firm, right? If you're the growth engine, you're clogged up, it's going to eventually plateau the growth of the firm. But if you're in the scaling game, you're leveraging other advisors on your team. Your metric should be, what's your revenue per team member? Specifically, what's your revenue per advisor? And you should be looking at, how can I fill those advisors up? I'll show you some industry stats of how much in revenue and clients that they're managing on teams right now, because it's pretty impactful. But you mentioned this one earlier. If you're going to be really good at what you do, you've got to optimize your existing book. And a great measurement for that is, what's your revenue per client? Yeah, I got the industry stats for that too. But if you're really good at these two things, if you're really good at scale, which to me is like the foundation of a house or a building, the first floor is like client optimization. If you're solid at those things, you could build unlimited floors. What advisors like to do, this is my favorite stuff, the growth stuff. I love it. I love organic client acquisition. I love practice acquisition, but it's like the second floor of a house or a building, and everyone wants to start building on the second floor. And when they do, stuff falls through the cracks, right? It's not great. So real quick, some of the industry stats here. Look at this on the right. The average advisor working for a practice is managing close to 150 clients, over 1 million in revenue, over 100 million in AUM. That's the game, right? You've got to fill up the capacity of advisors on your team if you're going to scale. And the average revenue per client right now, 10,300. That's the average revenue per client of a financial advisor. They have a little over 1.5 million AUM. They're really huge. But in these, you're really talking about these, Aaron. I mean, to me, these are the constraints specifically for acquisitions that hold advisors back that we see. It's sourcing enough deals because they don't all work out. A lot of advisors just don't have access to deals. We got some shortcuts to that. I find negotiating the deals, most advisors don't have a process. They'll go through and do some things that actually will repel a potential seller that they don't realize they're doing. And then there's a lot of terms on deals. And I'm telling you, a little term can turn off a seller and kill the deal at the 11th hour, like at the altar. So really being able to close all the details. I mean, these are the three areas that we see that just prevent advisors from getting enough deals to growing and scaling. But you're really, talking about those, but is working with mostly buyers is what we do. And we just see these being the things that they just hold advisors back from really growing to the next level.
Yeah. And I think one of the best, takeaways out of this conversation is, in terms of kind of evaluating and as we look into deal structures here, is getting evaluation on your own firm. And like I said, understanding all the metrics, because I think it gives you the understanding of what is my modern pricing, what are my expectations. And we field a lot of phone calls where somebody says, I'm looking to make this acquisition and I'm thinking, 2 to 2.5 times. And I'll sometimes kind of chuckle because, the reality is you really have to understand, again, what your competitors are offering and what your own firm is worth. And if I think you can understand what your own firm is worth, it helps you relatively price. It's just like what we would do if we were listing our house, right? You get online and you start to search at what other homes in your neighborhood might be worth. Based on the types and features and qualities that you have in your home. It's the same thing here. If you've got a valuation on your own business and based on those metrics you said, I've got an average, client household of 1.6 million and this seller's got an average household of 800,000. How does that look? Is that something that it can service up to? And does that impact price? And, what does that mean if my enterprise is worth this? How am I evaluating their enterprise so you can appropriately price it? Because I think, I think my number one takeaway is I think buyers often underbid when they're competing, believe it or not, as opposed to overbid. And I think, that's something that we'll talk about it with deal structures. I think as an independent buyer, you can win with security, you can win with customization. But you still have to be in the ballpark of price. You're not going to go out and get these just incredibly, off-market deals unless the seller just is a unicorn and is not, talking to anybody else. Right.
Yeah. It's so true that sellers think it's worth more, buyers think it's worth less, but somewhere in there's the right spot. Well, let's hear about, I love always hearing about, deal structure. You mentioned multiples you're seeing. What's the latest there?
Yeah. So a couple things I'll say is, as we're talking is, deal multiples are a really dangerous game to start into the comparison. That's why I say I really like the valuation because we are seeing this. I liken them to NFL contracts. So some of these aggregators, these integrators are coming in and they're saying, hey, we're going to offer you this 12x of EBITDA. Well, what is that EBITDA? Is that EBITDA a normalized EBITDA that based on my P&L, or is it an EBITDA based on their infrastructure and some of the costs that they have as an organization? And so we really see this as that there's kind of some, false inflation of EBITDA values. But I'll throw it out there and I'll talk through this and then we'll talk deal structures. In general, what we're seeing is that the majority of these practices are going for a 3 to 4.5 times top line revenue. That's an easy, map that covers most of the market sub, let's say 750 million. Once you get into that, $1 billion space, you're looking at probably a 3.5 to 5 times top line revenue that these businesses are going for. And so I always like to look at these as a combination of what's the relative top line value and what's that EBITDA value, because these are moving targets, right? We've seen some inflation in the last couple of years. Interest rates have started to come down. The number of sellers is probably shrunk a little bit because there has been a lot of aggregation. There's talks that we saw kind of our peak values and peak deal volume in maybe 2022, right before we kind of had a little bit of a down year in 23. And now we're seeing a lot of activity, but there is demographics at play, and we've seen a big wave of sellers. So what we're seeing right now is if you're a firm that's in 100 to 300, 100 to 400 million, 8 to 10x of EBITDA, of kind of a normalized EBITDA value. And that normalized EBITDA typically means the bulk of your expenses stay unless there's rent consolidation, and there's usually a normalizing of seller salary. And so then, we get into that 300 to 600, 300 to 800, you're in that 8 to 12 times EBITDA range. If you're looking at 600 to $1 billion, I want to say you're in that kind of, easy 10 to sometimes, 12x. And then we'll see incentives beyond that, right? So you might see a seller is getting a deal where it's a baseline 10x on their $700 million firm. And then they have those growth incentives to get another, 3x of EBITDA. Well, again, that might be paid out over 3 to 5 years and requires them to grow at 20%. So you really kind of ask the questions and start to get into the details of it. So when we see these articles in the paper, or in the press, I should say, that's where I say it's like an NFL player who gets $100 million contract. Well, $40 million is guaranteed. There's a certain amount of base salary, and then there's a lot of incentives baked in. These are very similar in a lot of respects, right? And then, the $1 billion firm is those of you guys are growing and you want to get to that $1 billion benchmark. We're seeing an easy, 12 to 15 times multiples. We've got a client that, we're talking, $2.5 billion firm, and their kind of internal succession value is somewhere around that 12 to 13x of EBITDA, for kind of a fair market, younger partners buying in type of value. So, values are good. I think, at the end of the day, as long as private equity stays in this industry, which I think it will, because there's good profit margins, we're not in a massive bubble, I think, of valuations. I think at the end of the day, valuations are competitive. We've probably normalized valuations over the last decade, as access to capital has gotten easier. So people always ask that too. Are we in this massive bubble and we're going to see valuations crash? I don't think so, unless there's outside factors that impact that, whether it be, AI solutions or whatever. But I think the core value of this business and the value of advice has been demonstrated. And so I think our valuations are kind of, here with maybe slight nuances and inflections based on market conditions or what have you.
Yeah, it's nice to hear that there's valuation data on EBITDA profit, right? Because top line's a nice universal thing, especially for, there's a trend of some wirehouse, more traditional employee advisors are moving, right? And that's a universal value that you could use. But at the end of the day, a practice that has a low profit margin, like, it's not that valuable, right? Versus one that has a high profit margin.
Exactly.
You could go after that deal, right? It's worth paying more there because the deal more than paid for itself. So it's a better evaluation point. And I think in there for everyone, it may not be your tax return, right? If you have some extra expenses in there, it's not exactly that. I think another term that's thrown around too is EBOC, earnings before owner's comp. So if someone's like taking a salary from the business and they have profit, like it's really that, because it's what would a buyer be getting, right? What would a buyer be getting? What can they use to pay debt service and
use to service that debt? That's right. Yep. And that's where it comes back to, I think as a buyer, your best strategy is to keep it simple. And so it's understanding kind of what the seller's expectations are of that value, being prepared to say, how do I finance that value? we see most people finance 100% of the acquisition price because they can spread it over a 10-year amortization period. It gives them the maximum cash flow. And we're seeing values come in at 60, 70, 75, 80% up front. So you're putting a significant amount of cash into these businesses to give that security to the seller. What I like though, is then a fairly simple and effective true-up over the course of that first 12 or 24 months. How long does the seller want to stick around? How long do they want to work? Can they add value to your enterprise? And then sit down and have a conversation with them to create that and say, all right, your expectation of value is here. We're going to meet that in the next 12 months. If you want to create incentives or keep them on board, great. I saw this morning, it was a 8-page LOI going through the different deal, the metrics of the deal. If you start to get into an 8-page LOI, you've probably created more complex deal structure than you really want. If the seller can't understand it in 5 minutes or less, you're going to lose them every time. Right. So I say, keep it simple, keep effective. Cash is king, offer them security up front. If there's somebody that wants to stay on and they're a little bit younger and they feel you can add value, great. Add some incentives, add some growth incentives in there. But there's that expectation that you're going to really deliver them the bulk of that value in the first 12 to 18 months.
Yeah, that's a great, really great point. And remember, just going back that doing those deals, once you get the deals, and again, if you're really good at client optimization, right? I find a lot of times that sellers do have a lot of opportunities with their clients they've left on the table, right?
For sure.
If they've mentally thought about getting out of the business and, probably the last 2 or 3 years, they're not going after all the things, right? Their exit ramp has started. They're not capturing all the opportunities they could. And maybe it's their got one foot out the door, but it's also maybe they didn't have the resources that you as a buyer have that could bring more to their clients, which is exciting. So I find a lot of the best acquirers, they'll just have good profits and a good lending partner like Spruce Rock, but they also have the goods to deliver. They've got the capacity, they've got systems to deliver more to clients, and going back to revenue per client, they can enhance the revenue per client, which I'm telling you, it just all goes to bottom line and it all drives profits.
And sometimes it just comes to a succession plan, right? We see some practices where they're really dialed in and the seller really has a great enterprise. But at the end of the day, just that lack of succession starts to breed some questions from clients. And so you as a buyer coming in with that succession plan, I think you're automatically going to see some business lift. And we see the bulk of that kind of business lift and growth come in that first 18 to 36 months post-acquisition, as there's a lot of momentum. Like you said, you're implementing new leadership, you're implementing new processes, perhaps new services. And so, you evaluate that as a buyer and then you come in and really deliver in that first 18 to 36 months, you're just going to see exponential growth off of that.
Yeah. It's quite big. It's quite big.
Yeah.
What's, it's good to hear about the best practices and things like that, but what are you seeing as some mistakes for people that want to have more acquisitions? What are you seeing some mistakes, Aaron, to avoid and people should watch out for to make sure they're not setting themselves up for a bad deal, or maybe setting themselves up, their practice to not get many deals?
Yeah, that's a good question. I'll say one thing is always focus on your own organic growth. Your own organic growth as an organization breeds you that consistency of new revenue, that increased cash flow that really allows you to have more what I would consider to be kind of purchasing power. The second thing, and we're encouraging clients is if you're going to use bank debt, come to us sooner. Like once you've engaged with a seller and start to have a conversation around, all right, based on these rough metrics of what I think is the seller, how much of this can I afford? How high can I go on my debt totals? What's my own value? What are the key metrics that a bank is looking at? And just start to have a preliminary conversation around that. Because then as you're building that trust and that relationship with the seller, you can start to walk them into what you think is the deal structure and or the price. What we always struggle with is when someone comes to us with an LOI that they simply can't afford, either because they got too aggressive in a bidding process, or they hadn't cleaned up their own house and had too many expenses that were going to bog them down. And it's very simple. It's very easy to go do this, what we would consider this pre-flight underwriting or this analysis of how much cash flow and what kind of deal structure can I present. And that way you really come in as an informed buyer. You can guide that seller into those conversations and you can deliver on the deal structure that you're presenting to them, which just solidifies that trust that you're coming up with. So we have a service now where we are having clients come to us. We're pre-flighting those, and in the course of typically a week or two, we can spit out for them some results and some tangible results and some deal structure ideas that they can go and take away and continue to court, whether it's that seller or other sellers that you're working on in your pipeline.
I love this. I think the preparation is such good advice, really setting yourself up to win. And it's again, I'll say it again. If you've got a deal in your pipeline, awesome. That's great. But if you don't, this is the time to do it, right? Really get your house in order.
Yeah. It's that preparation. It's that preparation makes such a difference. And I would say it shrinks the closing time too, right? I mean, we do see some of these deals drag on 9, 10, 12, 18 months, right? And so having your house in order, being prepared, it's so much more efficient as a business owner and as a buyer when you have all of these items put together.
Yeah. Yeah. It really is. And when it is together, it can, not that you want to close too quickly, but it's nice if you do have somebody who wants to sell and you want to buy. It's nice that, hey, let's make this happen.
You ready when it happens?
Let's drag out for you. Let's make it happen.
Inevitably always happens too, I find, is that buyers go out and do a deal, and then that just, somehow has a ripple effect through the community, and people hear about a successful transaction and the next one comes right behind it, just when you weren't expecting it. Or as I see with clients all the time is, I was working on and courting these 6 sellers, or in building relationships, and all of a sudden 3 of them come to me at once. So being prepared and understanding that, and then knowing which ones you need to pursue if those, items come up for you. What do you pursue? What do you drop? And how do you maximize your results?
Pretty awesome. It's pretty great. And I love you mentioned the buyer checklist is something that we can get out to everybody. But you also have too the things to use with the seller, right? Isn't there when you have somebody some checklists kind of with them too?
Yeah, correct. Right. I talk about it's all of that. What's my business vision? What's my client service strategy? A written policy. This is how we operate. This is how we do it. These are the committees we have within our organization. These are the key performance metrics that we measure as an enterprise. I mean, any of this data that you're going through with your clients, I think it's fantastic information to share with a seller, because it really helps them understand who you are as a business owner. It builds that trust, and it shows them that you can handle the acquisition, the onboarding of their clients. And that ultimately is what matters to them. I'm going to see my clients after I've retired at the grocery store, out at the golf course, whatever. And I want to know that they're in good hands. And that's what a lot of these sellers are really looking for. Is to make sure that they, walk away from this industry with their head high and their clients being really well taken care of.
Yeah, that's great. So we'll get those to everyone. We'll open up to Q&A here, where we can keep, going back and forth. And so much great value to this, but we could use the chat. You can just come off mute if you want to. I'll throw this out too. We hold every couple of weeks a scaling workshop at XFA, and really it is designed to how can you grow and scale your practice like some of these really big producers are. Today I talked to another Barron's Top 100 practice. They literally started with us going into 2020. They were stuck at 1.2 million, and they're going to cross over 30 million in revenue this year. I mean, it really can happen that quickly, but there's definitely some constraints to overcome. There's definitely some shortcuts that you can take. And that's what we cover in our workshops, is just get your practice ready to really grow and scale like some of these fast ones. So any questions from the group, go ahead and pop them in there. Otherwise I got a million, Aaron. I can ever do it.
Well, I'll add to it, because I think that's the number one debate for any buyer is, when do I hire that next advisor, or that, that can handle that capacity, or do I do it through the acquisition? And so I think that's where it is, knowing what your profitability per client is, and being able to say either, one, I've got this Rolodex of people I can hire quickly if this selling situation needs it, or I'm acquiring talent within that organization that I feel I can use and scale up. I mean, obviously that's a big part of what people are doing right now is kind of acqui-hiring and, there's great talent out there in this industry. And so if you can do an acquire and grab some new talent within an organization, great. Or if you can pull away talent from a different organization because you're going to make an acquisition. And now you're saying to them, hey, I've got that runway. I've got that capacity. I've got that growth opportunity for you, advisor. And oh, by the way, that might come up with some opportunities for equity or buy-in down the road. So give me all your time and your energy. And I think you'll see a lot of these young advisors are ready to go. They're ready to perform.
Yeah, definitely. I find a lot of times in so many acquisitions, the like junior advisor, if you will, really hasn't been allowed to do things. And I think just from a psychology standpoint, the founder, owner, originator of the practice has kind of been doing things their own way. They really haven't allowed themselves to get out of the way and let somebody else rise as the star. So I find there's some good people that's just untapped talent that, they could run $1 million in revenue for you. They just haven't been allowed to. That is a great thing.
And I think nothing demonstrates trust to a seller more than a buyer that has really empowered the employees to take on more responsibility and has said, hey, my employees are so good, I'm turning over my top clients into my team, right? And that's a real big element, I think, for acquisitions and successful acquisitions. I think we see a lot of our serial acquirers that have used bank debt and purchased a number of practices start to step away from client relationships. They built out that team and they're serving more as that strategic figurehead, revenue generator. And that really opens up and continues to open up acquisitions.
Big time. It really does. Yeah. It's, it is interesting what you see there. When you look at, some practices, and hopefully no one else will make this mistake, but it's a very common mistake to just, I got another advisor, I'm going to dump all my small clients on that, right? You see this a lot where the talent's just wasted, right? They should be working with $1 million+ clients, 10,000 revenue, industry average clients plus. They really should be working there and learning how to do that. But there's so much of, hey, I walked uphill both ways in the snow barefoot, and that person has to do it too.
You gotta throw that mentality out, right? I mean, that's why I'm such a big believer in what you're doing as a business coach, right? Because I think you really have to say, how do I build that team? How do I empower my people? And how do I take those kind of uncomfortable steps, if you will, to grow my organization? Because I think it just makes it that much better.
Yeah, it really does. Really does. So, great. So if there's any other questions, we're happy to take them here. But this has been really fantastic, Aaron. I'm so glad you got some free resources that we can get out here, the buyer's checklist, the seller's checklist. So we'll get that out to everyone as a follow-up. And hey, we'd love to see an exit-based scaling workshop. Just click the link there, see if you qualify to come in. But I think just learning, the fact that people on this, I mean, that they're learning, they're getting better at their business. I love that. I mean, to me, they're already above average advisors on here, not knowing their metrics or their AOM, anything like that. Yeah. But just to learn what's going on, I think is big. And this one's kind of a mystery, Aaron. It's great that you share what's really going on and you see more deals than anybody. And for you to hear from a pro like Aaron on here, to learn this is how deals are done. This is the structures, right? These are the multiples that are going on. This is how you can get yourself ready to win. Watch out for these things. I think there's so much learning in here, and this will be recorded. There'll be replay available, but this might be one to go back to, right? That might be going to go back to where your opportunities are and pound on some of these, because there could be years of implementation just from some of the things that we talked about here. But if you pick out a small number of things just to make your practice a little bit better, which could be as easy as connect with Aaron and start your, preparation, right? Get yourself ready, not just a buyer checklist, but really work with the lender and know your buying power. I highly recommend doing that, just so when the deal comes along, you're ready to roll.
And pick up the phone. I always encourage questions. I'm sure you're the same way, right? I sometimes like just grabbing off the cuff phone calls. We'll talk about, things and help people get started. Sometimes it just takes that in a digital age. Sometimes a human voice is nice, and we always encourage conversation. We always learn something from them, and I think it adds value. So always welcome those phone calls.
Very awesome. Great stuff. Well, Aaron, thanks so much for being on here, sharing so much knowledge. We'll get some follow-ups, everyone. And thanks everyone for being on.